I've had a few questions about the output that Equidam generates for startup valuations. And as it's a kind of impenetrable 34-page PDF, I thought I would do a quick walkthrough, show you what's included, explain a bit about how it's used and the value it adds to fundraising negotiations. So, in the case of the company we're looking at here, obviously it's a sample company, a demo company, one that I use quite frequently. So, kind of seed stage fintech based in the UK. So, to begin with, obviously, table of contents, summary page. So, this is all of the key information about the company and the opportunity in question. Yeah, you can already begin to filter quite quickly based on the detail here. There's some visualization of the financials that we collect as a part of the valuation process. Gives you a look into the future, projected growth rate, the kind of journey towards profitability. And past funding rounds, obviously very useful to know. Current ownership, primarily you probably want to see things like what percentage do the founders still have at the moment. Maybe other investors could be a concern in some cases. The valuation itself, you know, could be an entire video on its own, and probably will be at some point in the near future. But just to run through that quickly, we use 5 methods in our methodology, uh, deliberately chosen to give different perspectives on the value of a company, and particularly for early stage companies. So, scorecard and checklist, particularly, are the relevant ones there. They, the earlier you go in the development of the company, the more, the higher a weighting those 2 methods are going to have in the valuation. And they look at verifiable characteristics of the company, could be related to the team, the market, the product, the IP. They connect those data points with kind of research backed risk factors for startup success. And then they benchmark against regional valuations, either an average for scorecard or a maximum, which is like a top quartile for checklist. And the reason why we use regional valuations is because the the region the startup is incorporated in is has a much more significant influence on valuation than the industry it's in. Whether you're in the US or whether you're in Colombia, that's going to have more of an impact at certainly at very early stage at least, on your valuation. Also, when you start benchmarking with industries, it gets a little bit more pro-cyclical very very quickly. Particular industries, obviously AI at the moment has a fairly clear bubble in the valuation, and that's not something we'd want to build into our model. But yeah, hopefully that's clear. The VC method, on the other hand, is obviously quite a standard way, a relatively simple calculation of exit potential, whereas the DCFs, the discounted cash flows, they provide a perspective on the future financial performance of the company, the cash generation potential. And because they're based on the projections, they're really giving a more kind of specific look at the company rather than through comparison. Although obviously the DCF with multiples is using multiples, so there is a kind of comparative element built into there as well. This is what that valuation looks like if it's a fundraising round, if it's an equity transaction. The low bound and high bound are like the reasonable margins for negotiation. They are based off the variance between the 5 methods, just to clarify that. Use of funds, obviously quite useful information. And if you are doing a benchmark valuation with us, then you can put all of this in context. In this case, it's filtering for a sample of companies, both in our historical data, also from Crunchbase. So it's looking at fintech companies in the startup stage across Europe. And you can see it kind of drills down to a sample of 65 companies in our data, which is valuation, funding round, and financials, and 1,400 from Crunchbase, which is valuation and funding round. That can give you context on obviously on your valuation, the funding round, the equity percentage. You can get some recent similar rounds. Industry matching isn't always perfect here, but it's still useful context. Particularly useful is the revenue growth and the following page on the kind of EBITDA margin. It's very difficult for founders to know what a reasonable projection looks like. Here we give them a bit of guidance by showing them the average for that sample and then obviously the top and bottom quartiles as well. And funding budgets benchmark. Again, I think like underrated in how useful that is. It's very useful to know as a founder um, if maybe you're under allocating to marketing compared to your peers, or maybe you can see that they're all spending a lot more on operations than you are, and maybe that's like a something to look into. So then we get back to like the standard report, and we have a page for each of the 5 methods. We have obviously the value produced by the method. We give all of the background about the method, where it comes from, what it represents, why we use it. And with each of them, you'll see we are very clear and transparent about the drivers, the parameters involved, how the calculation works. We also have a methodology paper and resources on the website that give example calculations and all sorts, so you can dive in more there. And yeah, calculations, very clear. If you used our advanced multiples section, that lets you build a kind of list of public comps and derive a multiple from either the average or median of revenue or EBITDA. Then a P&L sheet, cash flow forecast, and then the appendix, which is a pretty exhaustive list of everything that is involved in the valuation, including data sources, how often they're updated. But pretty much any question you have should be listed here. And finally, if you make any changes to the default values, and you can tweak the parameters, pretty much any of the parameters, that will be explained in this last sheet just for transparency. So any deviations from the standard methodology will always be listed here. But in general, I hope that's a useful look at everything involved. I hope it shines a bit more of a light on the application of the report, specifically that it is not intended to be like a carved in stone valuation. This is an input into the process of negotiating a funding round, whether you're on the investor side or the startup. We work with both sides. It helps lay out all of the drivers of value. It helps explain what your kind of vision for the future is, the future potential through the projected growth and so on. Provides a lot of context around the market, provides some certainty through using kind of benchmark valuations as well. And through all of that, it's basically designed to help founders and investors close fairer deals at better prices in a more sustainable way, avoid the kind of peaks and troughs that we've seen in recent years, and ultimately, better support innovation, better enable the kind of fair and efficient allocation of capital to startups. So I hope that's useful. If you have any questions, feel free to drop them in the comments below.